Well, good afternoon, everybody. I want to thank you for joining us today for this webinar. This is our third webinar that we've hosted in the past month regarding property assessment in the region. As you all know, today's webinar will focus on property assessment in New Brunswick. My name is Mark Turner, and I will be the moderator for the webinar today. We'll do our best to keep things to the 30 minutes that we'd originally promised. We managed to do that in our other two webinars, so I'm confident we can do it today as well. On the screen before you, you'll see that we've listed our full arsenal of tax consultants, but to keep things manageable today, we are going to rely on our New Brunswick team. That's Andre Pouliot and Chris Job to handle the presenting. If you do have any questions during the webinar, please feel free to submit those to me as a message or private chat. I've received one or two of those from people already when they originally signed up for today's webinar. So I will save everything to the end and put those questions to our presenters at that point. So without further ado, I will hand things over to Chris Job. Chris is a manager with our property tax division in the New Brunswick market. So take it away, Chris.
Good afternoon, everyone. Thanks, Mark. Today we'll just be going over some just sort of general information. We'll look at who can actually file a review for their assessments. We'll look at the broad asset classes that are impacted by COVID, how the assessments have changed over the past year, and what Service New Brunswick has put in place to remedy any property owner that has been impacted by COVID. And then the most important question to ask yourself is, are you overassessed? And we'll go through some strategies as to how to best determine if you are in fact overassessed. So moving on. I'm sure any of you that sign up for our action alerts are probably saying, isn't it always the an assessment appeal deadline in Nova Scotia? And for myself, it certainly seems that way, because since typically in years past, assessment notices have gone out in March, and Service New Brunswick made a decision a couple of years ago, not COVID related at all, to separate the assessment notices from the tax bill, to just sort of trying to create less of a distinction between the two. So the plan was for 2021 for all the assessments to be delivered in October, as opposed to March. But with COVID, deadlines kept getting extended from March to April to June, and then a new batch of notices popped up in October. But that only impacted roughly maybe half the assessment roll, or half the property owners in the province, as they held back a broad range of asset classes, mostly properties that have income generating properties, so like hotels, motels, restaurants, offices, shopping centers, and airports. So who can file an appeal for our upcoming for the upcoming deadline in, I believe it's February 26th. Well, it's anybody that either had a request for review, had an assessment appeal outstanding from the prior year, properties that had any type of renovation or addition underway in 2020, properties that had acquired properties that were in those defined asset classes, hotels, motels, and restaurants. And yeah, so right now we are looking at the classes that have impacted by COVID, and like I said, it's a broad-ranging list of categories here, and I think we'll just go through the various properties that have been impacted and what as what percentage they've been impacted by. So if you can move to the next slide there. All right, so hotels, and these are one of the product classes that have been majorly impacted. Travel's down. People traveling is it's essentially been non-existent. And hotels decreased by a flat rate of 25%, and it doesn't matter if you're a brand new hotel building or with 150 units, 200 units. If you're a property, if you're like a mom and pop operation, the assessment has decreased by 25%. So I think a lot of the things that you have to ask yourself when you're looking at your assessment is, have I been impacted by more than the average or less than the average? And with hotels anyway, in particular, I know some full service hotels had closed down their fitness facilities and their dining operations, and it's definitely been a full grind. And with looking here at restaurants on this side, we have full service restaurants down by 25% and quick service fast food restaurants down by 15%. I know for the most part, everybody is takeout was primarily the only option to access these establishments. And I have clients that own a fast food restaurant, and they haven't opened up their the dining facility since March. It's been closed the whole entire time. I have others that have reopened. So each sort of situation is a little bit different, and again, that's a question that you have to keep asking yourself: is, have I been impacted more than the average or less than the average? Airports, similar type situation. No one's flying in and flying out. The restrictions have sort of really crippled a lot of airports. And I'm sure, Andre, if you want to step in and talk about airports a little bit more, then I know you have a little bit more experience with that than I do. But yeah,
sure.
Obviously, in terms of valuation issues, it's a lot of people can't get in or out. So
the airports are interesting, Chris, and I think anybody on the line, might they operate a lot different than, say, your typical income producing property. Most of them would have seen, I think the numbers, in the 90, 95, 99% that it's down, passenger traffic. And if you look at, say, some airports that have cargo, that may have been reasonably strong. But if you look at the infrastructure that's actually accessible, so be it the terminals and, the support structures, the fact that your cargo might have been able to continue along, it certainly doesn't. There's not a lot of accessible assets that go with that, because the runways aren't accessible in an airport at all. So it's hard to calculate the revenue. Generally, airports don't make money the way a hotel or a motel or a shopping center does. So I often look at those more like the way a heavy industrial plant would operate. And for anything that was down 100%, normally SNB would give us a 50% adjustment up front. So it was disappointing to see that it was only 25 in this one. But moving on, Chris, there's shopping centers for you.
Yeah. So, and I've for larger shopping centers, they've typically decreased about 10%. But I've noticed as well too that there are some multi-unit CRU spaces that have maybe less than the typical shopping center. Assessment increases and decreases there have varied slightly. So larger shopping centers for sure have decreased by 10%, but if you have a plaza that has maybe around 1 to 2, 3 units, then you may have not have benefited from the decrease in assessment. And again, offices, again, income producing 5% decrease, owner occupied 0%. And again, offices are one of the hardest hit with everybody working from home. It's sort of brought a lot of businesses to sort of restructure maybe their business plans going forward and how they want to conduct business. And with technology, it's so much more accessible to work from home and have sort of teleconferences via Zoom or any other platform. So income producing properties, yeah, down 5%, and owner occupied 0. So it's a bit of a discrepancy there between the two.
Which we were surprised to see, Chris? Like, we looked at that, and certainly Service New Brunswick held back the notices on both categories, so we would have expected them to be treated similarly. So obviously it was a conscious decision to, have one group at 5% and the other at 0. But the reality is they've been impacted all, similarly. It shouldn't matter, if an employer decides, if an employer owns their building and has half their people working at home, or all their people working at home, or if they rent a building and has half their people or all of their people working at home, one would have expected the value to change by the same degree. So we're vigorously going to contest this, and it'll be interesting to see the explanation that we get on the other side. But I think what I do now, everyone, is I'd like to move on to, are you overassessed? Because that's the question. That's why we're here today. You've seen what's happened with all the other asset classes, what's up, how much they're down. You can probably get an idea as to whether you're more than the average or less than the average, and whether or not you should contest something. So what I'd like to give you enough high-level tools that you can make that determination on your own. So in New Brunswick, the real basic thing, assessed value is equal to real and true value. Real and true value has been held by the courts to mean market value. And we're all about the time, so we need to know market value as of what date. The date is January 1st, 2021, which means we have to figure out what these things are worth in a post-COVID world. We have to figure out what a vendor and purchaser would agree something is worth after doing all of their due diligence on January 1st of 2021. I kind of did a little play with this, and I said I wanted to answer the question why you were almost always probably overassessed. And the reason why I had that little play on words there is because we're going to talk about statistics a little bit, and I know when I'm going to say the word normal distribution and people's eyes are going to glaze over, but I'm going to make this fun and easy to understand. So I need you to get familiar with just a couple of terms. ASR is an assessment to sale price ratio, and it's the simplest thing in the world. It's the assessment divided by the sale price. So if you own a property that's sold for $1 million and is assessed at $900,000, its ASR is 90%. And this analysis drives everything. It drives all changes in assessments every year. Assessors are trying to make sure that on average, all of the properties are assessed at 100% of market value. So what you'd find, in a very small assessment jurisdiction, one that we might call monopoly, is that you'll have a sample of sales that represent all of the properties in that jurisdiction. So what you have is, and they don't all sell for exactly the sale price. On our monopoly board here, we have Baltic at 75% of market value, St. Charles at 90, Boardwalk at 100, Marvin at 110, and Park Place at 125. So very quickly, you can see that this model doesn't get all the properties exactly equal to their market value. It gets some that are too high, and some that are too low. So eventually what happens is when you add, thousands and thousands of properties, you get a probability distribution that looks like what you're seeing. And what you're seeing is that little blue space that, most of the assessments are between 80 and 120% of market value. So some are too low and some are too high. You're going to have some that are kind of ugly. Those ones there are easy to fix. Usually usually there's a gross error, and there's some that are ugly too low. They're assessed at 40% of market value or 60% of market value. But the takeaway, and this is why I say that you are almost always probably overassessed, is that at the end of the day, even if the assessment office runs models effectively, half of the properties are going to be assessed too low and half of the properties are going to be assessed too high. So there's a pretty good chance that you're going to be in that 50% of assessments that falls, on the right side of your screen. So at 100 to 180% of market value. And that's why at the end of the day, the appeal process is so important. So how are you going to know? We've got a few things that we look at. We've got a large database of properties, and these are the types of things that we'll look at when somebody calls us over the phone. So we'll compare our year-over-year increase. So how much did the property increase by last year? How much did it increase maybe on a 5-year basis? And when we're looking at that, it's important not just to say, well, did it go up 3% or did it go down 10%? It's hollow comfort, in my opinion, if my assessment went up by 5, which doesn't sound like a lot, and everybody else went, stayed the same. It doesn't feel like I'm fairly treated. Similarly, if everybody else went down by 25 and I went down by 20, I wouldn't feel fairly treated either. So that's certainly one test that we do. The second one we do, and again, we do this right over the phone, or if it's a more complex property that we don't have data on, we'd have to dig it up, but we'll simply compare the assessments per unit. So if we get an apartment building, we'll say, hey, is it assessed at 80,000 unit, 100,000 unit? How does that compare to other new buildings? If it's an industrial or an office building, or a shopping center, again, we'll quickly dissect that value and work it out on a per square foot building basis. Again, we want to try and compare like with like. So if we've got a large, owner-occupied or a large office building that's Class A, we try to compare the assessment per square foot, with other large office buildings. Hotels, it's the same thing. So I don't really want to compare the Delta in St. John to, a Comfort Inn, out by, in Miramichi. What we want to do is compare like with like, and hopefully if assessments are being administered correctly, there won't be a ton of variance. If it's raw land, we want to look at the land on a per acre or per square foot basis. And again, we're not going to compare land in downtown Moncton to, land in Bathurst. We are going to compare it like with like. So we'll compare your vacant lot on Main Street in Moncton with the vacant lot in Main Street in Moncton. If you're on Prospect Street in Fredericton, we're going to do the same. And it's noteworthy that these are, you'll see I've used the word screening. So these don't really have any, when you compare an assessment per unit, it doesn't really have any, it's not an actual ground of appeal. All it does is allow us to determine if we're treated similarly with other properties. New Brunswick's the only province in Canada where you actually don't have to be treated fairly. So assessments in New Brunswick, you could have, 10 office buildings and they're all assessed at $50 a square foot. And certainly when we screen yours, if it's $100 a square foot, it would look to be high, and so it's worth investigating. But at the end of the day, Service New Brunswick, you would not have a case at law for a reduction in your $100 square foot assessment if that's what its market value is, even though everyone else can be less. So I did want to make that distinction at this point. So the second thing that we'll try to do is look for things that the assessor couldn't have known when they set the assessment. Inevitably, how assessments are set each year is they look at those ASRs and they say, do we have to add 5%, 3%, 10%? How much do we have to add to all the assessments in our jurisdiction in order to be at 100%. So that doesn't allow the assessor to determine if there's any capital expenditures required at the property. It doesn't allow the assessor an opportunity to determine if there's been any changes in income, if there's vacancy. If you're a manufacturing plant, there's no way for the assessor to know if you've seen production turn down. You know, if you look at individual nodes within a market, if you're up on Trinity Drive and Costco's gone, Cabela's gone, you know, and we've seen traffic patterns change that's impact property values in that area, you know, usually that's not going to come across in, you know, the factoring process that the assessor does. Industry downturns is the same. You know, we might see one sector that's been more profoundly impacted than another. So that would certainly be something that doesn't normally come up. You saw pulp mill reassessments, I'm going to go say about, you know, 15 years ago. And, you know, at that point in time, it was a response to, you know, the industry had turned down, but nothing had sold. So assessors didn't know. So go back to 2013, which is about 7 or 8 years later, it required a big and drastic change in values in order to correct them. So here's a few other things to consider, and this is where you have to sweat the details. You could go into your assessment and calculation and find that there's a simple math error. You could find that there's some simple inconsistent modeling with a cap rate or a land rate. If it's a piece of land, you might find that you know, you've got the base land rate for Main Street, but that there's a slope at the back of your site that hasn't been accounted for. One thing that we see a lot of times, and it's a definite no-no, is what we call sales chasing. So that would be selectively reassessing a property that's sold so that you can get to your, you know, desired level, rather than updating your models or increasing assessments across a broad class in order to achieve that level. So, so that's critical as well. Classification is something that people don't always think of, but classification means whether your property is going to get the residential or the non-residential rate. So you have to look at the use of the property in determining that. You know, you can look at the actual use, you can look at the zoned use, all those things. And then last thing is development potential, and that's when we get into speculation. So are we speculating on, you know, the property's future rather than looking at how it's actually performing, and how do we account, and how should that be accounted for? So at the end of the day, my advice to everybody is, if you're not sure, file an appeal. We call it New Brunswick request to review before the deadline, and that's on February 26th. The key with asking for a review is it's truly the most important part of an assessment process. Most of the taxes you pay are self-assessed. So when you pay income tax, you calculate your own assessment, you hand that over to CRA, and then they review it. Same thing goes for your HST submissions. You know, you file your HST, you know, you self-assess, and then it's up to the taxing authority to review it. Property tax is the only one that works in reverse. It's the assessment office telling you what they think you should pay, and they're asking you to review it. So when you get your assessment notice, you're technically doing nothing is essentially approving it, and filing a request for review is conducting a review. So I'm generally bullish on advising people to be proactive with it. If you've never reviewed it before, it's important to do it. And if you're sitting there today, and if you're any of those affected property types, what you really need to ask yourself is, if all hotels went down by 25%, and it's the Delta in Moncton's gone down by 25%, and so is Mom and Pop in Edmonton's down 25%, and so is the great property that's down in St. Andrews that actually did better throughout COVID because people stayed at home. That's down by 25%. I think it's important that you look at your own circumstances and try and determine if you're more than the average, less than the average, and then request a review. And the same thing would flow through every one of those asset classes. If it's retail, do you have a certain type of tenant class that's been impacted more than others? And know if you've been impacted. You know, it's easy if you have a call center with a great lease where that income is going to be steady for the next 10 years. But there may be hidden effects. If I'm going to buy that building from you now, and I have to guess at whether I'm going to get that income for 10 years or 5 years, or what's going to happen on renewal, there may have been a hidden loss in your property's value that you haven't seen. I mean, the rent checks kept coming in every month. But if that call center is operating twice as efficient with their employees at home, how probable is it that they're going to choose to renew their lease? If it's a law firm or an accounting firm, and we think that they may prefer to have less office space, use hoteling to get in, then even though the rent checks came in through COVID, you might have had a hidden loss in your value that you're not sure of. And me or anybody on my team would all be very happy to kind of walk through this stuff with you as you have questions about it. So with that, the team's on the board. I'm not sure how many questions have come in because I've been talking, but I'm sure Mark can tell me if there've been any.
Well, I had five questions total, and that includes the two that were submitted beforehand. I think you just answered one of them. So I'll go from the top here. One question that's not unique to New Brunswick, but certainly applies there, is how are partially constructed buildings treated for assessment purposes?
Okay, so that's a good question. Jurisdictions in New Brunswick and Nova Scotia are a little different than the rest of Canada. So we don't have what we call supplemental assessment in either New Brunswick or Nova Scotia. So rather than wait until a project is finished, put its full value on the roll and then adjust it for the number of days in the tax year, what New Brunswick does, similar to Nova Scotia, they try and estimate the value of that partially complete construction on, in this case in New Brunswick, on January 1st. And that's a tough one. We've got a lot of cases going in Nova Scotia, but particularly this year, if you're in New Brunswick, the question you need to ask yourself is, if I got $1 million in the ground in January this year, how is its value different than maybe in previous years? Is my project over budget? Did COVID inflate the cost such that my partially complete construction would have a heavier discount to what it normally would? We generally take the position that selling a partially completed the market value of a partially completed project is not equal to its cost. There's a ton of risk there that anybody would have to take on in order to take over a project, and developers, they want to be, they're not gonna give anything away. They're gonna want full profit up front. So I'm bullish on those projects, but again, what you have to look at, I would start by looking at my assessment as a percentage of what I've got in the ground, and then I would ask myself those questions. Should it be a 50% discount? Should it be a 75? Is it a complex project? Is it a simple project? So that's those are the questions I'd ask myself if I was reviewing, a partially completed building assessment.
All right, next question. This person says, I have a piece of vacant land. I don't have sales to rely on for checking my value. So if my assessment per square foot is the same as the assessment per square foot of a vacant parcel up the road, is that a good enough check? Or are there other things that I should do to consider?
So I would say in the absence of market value, you fall back on consistency. So if we're setting all the rates on Main Street at $10 a square foot, and you're at 10, that's probably a decent place to start. But what I would caution people on is making sure you're comparing like with like. And it's very common in land assessments. So you could have, $10 a square foot being the average for all of the land. But if I've got less frontage and more depth than a comparable lot, then maybe I should be lower. If I've got a slope at the back, I should be lower. If I've got powered line easement over the top of my property, I should have a discount. So what you can then, if you in the absence of sales, you'd have to rely on an opinion to determine what that adjustment should be. And assessors are quite capable of making that judgment. They're actually required to under the Act. And what you want to do is make sure that you develop an opinion the best way that you can to back it up. So
I guess some other things that come into play that any property owner would know is, are there easements or rights of way of my property? If there are, and there aren't on another one, then that's something that should have an impact on the assessment as well.
100%.
Next question here. What if there is additional competition moving into the area, but they aren't yet built? Is that relevant to my assessment?
Okay, so in a nutshell, yes. So again, the framework we're trying to determine is, what would a knowledgeable buyer and seller consider on the 1st of January? So what would they pay? If it's no secret that, you know, there's development going on, there's permits for 50 apartment buildings to go up around you, that's certainly a factor that needs to be considered in setting the assessment. You know, what we're assuming is that buyer and seller have both completed all of their due diligence on January 1st, and they're going to negotiate a price that's fair based on all of those facts.
Okay, so we're just hitting our 30, well, actually we're at 31 minutes, but I do have one last question here. And I know you had the slide up about owner occupied versus income producing office buildings, and it was odd that one of them, one group was going down by 5% and the other were basically staying even. And you mentioned that you were expecting them to be the same. Any idea why one subset would be going down and the other subset would be staying the same?
I would be guessing. I'd be guessing what the rationale was. I'm going to find out though, because I've got a lot that I'm appealing. So, but I'm guessing they're looking at, they tried to look at rent loss or rent abatements that were given out during COVID. We responded to a lot of requests on behalf of owners that Service New Brunswick made when they were doing their reassessment. And my guess is they had made the determination that they'd make their adjustment based on rent loss. My own personal belief is that, you know, just because I own a building, if I didn't own the building, I would be renting it, and I would have the exact same probability of a rent loss in that building as I would if somebody else was renting it. So I think the two should be treated exactly the same. Again, you know, remembering, of course, that 5% is the average, and that within that subset, some should be more than the average and some should be less than the average. But on average, owner-occupied office buildings are no different than leased office buildings.
All right, excellent. Well, we are now at 33 minutes and we said that we would take 30. So I want to thank everybody for joining us. And just a heads up, we will be posting a video version of this on the webinar section on our website at turnerdrake.com. If you need a copy of it, you can certainly go there. Or if you wanted to refer anyone in your office to it. So thank you very much, everyone, and happy appealing.